And we often try to simplify it. I know a lot of people are intimidated by this idea of accounting or understanding the numbers. But we frequently refer to three basic financial statements. And what we're going to do in this class is break them down. If we can, one by one, let's talk a little bit about the income statement and how does an entrepreneur, a small business person approach that kind of financial when we don't have a lot of history, when we don't have a lot to grow on and go on. We're just kind of making this up as we go. Income statements.
So income statement, obviously one of the three important statements that we learn about and that's utilized in business. The income statement, also known as the profit and loss, right? That's a good way to kind of think about it is, how do you look at your revenues minus your expenses and then what's left over, right? And what do you do with what's left over? That's the profit or the net income. And so what I like to do is look at it from a revenue perspective. And again, most of this is basic arithmetic, right? It's adding, subtracting, multiplying, or dividing, right? So you don't have to, again, be a math genius. You don't have to have a background in math to go ahead and understand it. But just simplifying, you have a product. The product has a price, right? The product or the number of products you sell times a price is your revenue, right? And the expenses. And one of the things that's important as you're building out as an entrepreneur what your budget is going to look like, especially in the first year, is capturing all of those expenses, right? From what are you paying rent, because you're renting a building, any insurance, right? There's so many different types of expenses that you have to make sure you account for. It's much like building your own personal budget just on a business level, right? And then understanding, okay, this is what I expect in my net income or my profit, but then what am I doing with that? Am I plowing that back into the company? Am I distributing it to myself personally? We all know that the government receives a percentage of that in the form of taxes, right? So just getting an understanding of what it looks like, and that's the financial performance of your company. A lot of times it's measured on a monthly basis, quarterly, or annually. So, and it's aggregated, right, over the first 3 months, over the first 6 months, or over the first 12 months.
And for a startup, how many years do they need to have? What is a financier looking for as far as that?
The truth is, in reality, banks, lenders, investors may ask for 5 years worth of it. You don't know much beyond the first year or two.
And so the first year you might have that month breakdown or quarterly breakdown. The years 2 and 3 or whatever could be consolidated down. So your spreadsheet might show the expenses for the months, and then a year 2 and a year 3 or something along those.
A lot of times that's all that you need. Going out beyond that, it's an important exercise to think about what the financial viability of the company could be or will be from 1 to 3. Anything beyond that, and again, we've in my experience, I've spent a lot of time with from startups or large companies. The variance is so different because of, you may be in one economic cycle, right? The economy is growing, and we may be in recession in the next 5 years. So it's very hard to predict, but I would recommend, as you said, 1 year, do it on a month-to-month basis. That's your budget, that's your forecast. And then in year 2 and 3, just annualize it as to what you expect.
And what I've found helpful for working with small companies is make good notes. When you're making assumptions on your expenses and on your revenue, document that stuff, because a month later you come back to this and go, now, what was I thinking? And if you have good notes on those kinds of details. But also, where could somebody go get some of this information? If you wanted to try to gather historicals or comparatives, what are some of the resources you've seen used?
So there's tremendous amount of data online, right? If you're in a certain industry, you can go to that industry organization, and oftentimes you can pull a lot of that data right off their website, right? There's also, and within our own library, provides students the opportunity for IBIS World, right? And First Research. Those are things you can do that by industry, and you get data on trends, competition, what your financial ratio should look like. So there's so much data out there to build into what your model will look like. But you have to your point earlier, you have to explain it, right? Whether you're sitting in front of an investor or you're sitting in front of a bank, you have to explain what these projections are. Because everyone is going to be skeptical, right? It's going to say, how did you arrive at these? Are they conservative, meaning your sort of base case, right? Are they a worst case or a best case scenario? And so a lot of times, and we do this, right? It's natural. We want to hope for the best, a sense of optimism. That's great. But you have to be able to explain sort of the realistic aspect of the performance over the first 12 months or 24 or 36.
And if you're packing all that into a business plan, what would be your suggestion? Would you put in your financials a most likely scenario and maybe have in the appendix we have a worst case and a best case, or how? Because you don't want to load too much information in there.
Yeah.
If you're doing 5 years, do you do one version of it here and maybe some other places you have the rest of those?
Yeah, I think the most likely is what you want to present to investors or banks, and with notes. Include the notes in your presentation, and then you can have supplemental documents or in your appendix if you have other scenarios, a what if.
Yeah.
If this occurs, my revenues would be this high. Yeah. If this doesn't occur, this is what I expect.
Yeah, and one of the things that I have found helpful in working with income statements and working with banks is the idea of, if you have that best case and worst case, don't be overconfident, but don't be too timid. You want to show you have some confidence that you can make this happen, but it's got to be realistic. So you've got to have some connection to reality. And what I found, our business centers in North Carolina, and I think they'll still have these in the future, you can get an index of all kinds of industries, in all kinds of geographic locations, in all kinds of sizes, and they can give you by percentage what those expenses tend to be as a percent of revenue. For you pick an industry, you pick a size, you pick a location. So that's really helpful. And then if you can show you've got that kind of a reference, you're not just pie in the sky. So that's worked well for a lot of companies.